Thanks for listening to the Meaning Business Podcast. Just a quick disclaimer, we're breaking down a profit and loss statement, and visuals make it easier to follow. For the full experience, watch on YouTube via the Benchmark Business page when you search Meaning Business Podcast. And if you're listening, you'll still get valuable insights. Let's dive in.
So on this episode of Meaning Business, I thought we'd do something different today, Peter.
What's that?
Well, what I've got is some profit and loss accounts just to have a look at and just to sort of talk about the sorts of things that can be hidden or what you need to look for in a set of P&Ls. Now, I know some people will be really, used to looking at a P&L and think what we're talking about is not relevant for them. I don't know what's the top from the bottom.
Peter, can we go back, by the way, 24 years to my early business career and you take me through this? I wish I had known that then.
Yeah, that's right. So, sometimes to get back to the basics is really beneficial. So what I've got here is two sets of financials. They're pretty old. One for a manufacturing business, one for a retail business. They're both very different because in manufacturing you have cost of goods and you put labour into the cost of goods quite often because there's a labour component in manufacturing. And retail, it's a different story. All the wages go into the expenses. So I thought it'd be good to just have a look at those two types of businesses, two P&Ls. We'll take about 30 minutes just to go through some of the basics and hopefully people pick up something. So we're not talking about balance sheet today. We're not going to talk about depreciation schedule. We're not talking about cash flow forecasting. We're just going to talk about the P&L. And there's two parts to the P&L. There's the trading statement, which we've got here, and we've got the actual profit and loss. So first of all, the starting point is that the trading statement and the profit and loss statement are actually two separate things.
Okay.
So
what's the difference?
Yeah, so the trading statement just determines the gross profit. It's just what sales less cost of goods or cost of purchase equals gross profit. The gross profit is probably one of those great variables that we should be looking at quite often, we can learn a lot from the trading statement. So I want to just spend a bit of time on that, maybe 10 minutes, in both the manufacturing and the retail business. Then we'll have a look at P&L. Because in the P&L, we've got the expenses. And somebody told me in the 90s that every expense has a story. And that little sentence stayed with me, that, if you can find the story under each expense, you can really analyse that business a lot better and figure out if you can do something with those expenses. So let's start off with this manufacturing business. So the first thing you'll notice here is that we've got 2000 and something. We've blocked out the year. So when you look at this, 1 year is the previous year and 1 year is the current year. Which year do you think is the previous year and which year do you think is the current year?
Well, the assumption would be that the lower figure is a previous year and current year is the higher figure. That's the assumption.
Yeah, okay. So when we look at, if you flip over for a second to the retail business, you'll see that the previous year is on the right and the current year is on the left. When we look at the manufacturing business, the previous year is on the left and the current year is on the right. So as someone who looks at P&Ls a lot, you can't just presume that it's always in the same format.
Correct.
But the best way to figure out which is which is to start by tracking the stock. So the stock in the trading statement is probably the most interesting part of the trading statement. So if we look at this one here in 2000 whatever, we started with an opening stock of $18,000 and the closing stock was $19,000. That closing stock becomes the opening stock for the next year, 19,000, and then goes to a closing stock of 28,990.
Understood.
So we track it, we can tell that we're going from the left column to the right because the closing stock in the previous year becomes the opening stock of the current year. So that's a good thing to also look at. So what sequence are we looking at? Are we going left to right to left? And let's have a look at stock. So there's some more to find out about when we look at the stock here. So what do we notice about the opening stock in the first year and the closing stock in the first year?
Hardly any difference, isn't it?
Hardly any difference. The other thing is it's a very round number.
It is, yeah.
But the final closing stock is not such a round, lovely number.
Yep.
It's more of a accurate number.
Yep.
So what often commonly happens in P&Ls is that people use an estimate. It's not the real stock number at all. So 18,000, 19,000 are just an estimate. it looks like the closing stock there is 28,990. Now, if these were audited financials, we would have a stock take, an audit of the stock
The full list.
to get an accurate stock number.
Yep.
We'll come back to that in a second. Because the second thing to look at here in this trading statement is the gross profit. There's some other things. So the gross profit in the first year is 601,000. In the second year, it's 1,071,000, right? So I'm going to show you how we calculate gross profit as a percentage, because it's the percentage calculation that enables us to figure out, to compare one year with the other. So in the first year, we've got 601,483. Oops, I made a mistake. There's 601,483. And we divide that by 915,069.
So gross profit divided by sales.
Yes, gives us the gross profit percentage, which is 65.73% in the first year. So let's compare that with the second year, which is $1,071,145 divided by 1531071, and that's 69.96%. Can everyone see that? So now we can say, okay, the gross profit in the first year was 65%. In the second year, it was 69%. So what happened? It went up.
Yep. Slight increase.
Why did it go up? Don't know. Let's try and figure it out. Because it's this sort of analysis that enables us to make a list of questions that we can use to figure out what happened in the business. So the first thing we can see in the business is that the sales have gone from 915,000 in the first year. So what were they in the second year?
1.5.
Right. So how much of an increase is that?
60%.
Yeah, it's fairly big, isn't it? So you could calculate that.
That's actually quite a bit
As a percentage. That's quite a big increase, yeah, in between 2 years. Somewhere in the 2000s, we don't know what year. So it's gone up. Why? So let's ask the question, why did the sales go up? So sometimes sales increase when people discount. Quite often I've seen entire businesses and retail businesses, people will discount their retail prices and reduce their gross profit margin to increase sales. So that's why we compare the GP, but we can see the GP's gone up. So it looks like they didn't discount to increase those sales. They've maintained a 69% GP, or in fact increased their GP with the sales increase. So a big question is, why did the sales go up? How did that go up so much? So then within these cost of goods is the last thing we should look at here in the trading statement. So first thing is that we had an opening stock. So we made 915,000 sales in the previous year. Our opening stock was 18,000 supposedly. Our purchases were 251,000. We had $2,793 of freight, and our subcontractors who made this stuff, they charged us $60,000, giving us a cost of goods of $313,000. So you take $313,000 away from 915, and that gives us a $601,000 gross profit. I hope everyone's following. This could either be boring or interesting. I don't know.
Pause, rewind.
Yeah, that's right. So on the current year, we've got sales 1.53 million. We started with a $19,000 closing stock, opening stock, which was a closing stock from the previous year. We spent $337,013 on things to make this stuff. We had freight of $2,382. So even though we sold more, our freight had gone down. So that sounds to me like we were sending out the same or less amount of orders, but each order was bigger. So is that the case? Let's ask the question. And the third thing here is that the subcontractor cost has basically doubled. And that makes sense. We're selling nearly a lot more. So it makes sense that the subcontractor cost should go up as well, that we pay the subbies. So that gave us a gross profit of cost of goods of $459,926 and a gross profit of $1,071,071. The last thing I want to say here, and this is really, really, I love this one, really critical, is the stock. So these stock numbers on here, when people do a P&L, they usually estimate the stock. And the estimate will either be too high or too low. If this last closing stock is higher than the real stock, then we're artificially inflating the profit. If this closing stock is low, and a lot of people artificially put a low number in, the profit will be less. And people do that to try and save tax, avoid paying tax. Yep. Yeah, minimization. Eventually you're going to get caught out. Eventually one day you're going to have they'll sell the business or shut it down, and you'll put the real number in. So as a buyer of a business or a seller of a business, you need to understand all these things. If you're managing your business, you need to be looking at all these things, because if you think about it, that stock number is definitely wrong. And we've already figured out all the questions that we would want to know. If you own the business or you're buying the business, why did the sales go up? The GPs increase. How does that happen? Is it through efficiency because we're doing more transactions? And what is the real stock number? So that's what I get out of that one. Now let's just flip over a few pages.
I feel like we're becoming detectives.
Oh yeah, that's the fun. We're forensic accountants, Pete. So let's go to the trading statement for the retail business. It says example 2.
Example 2. Gotcha.
Now remember, this is the one that goes the other way.
Yep.
First year on the right, second year on the left. So let's start off by looking at the stock again, because that's the thing we're talking about. So the opening stock in the first year was 134,998.
Mm-hmm.
The closing stock was 145,613, I think that is.
613, yep.
Yep. And then the opening stock is 145,612. So maybe that's a 2. Maybe that's a 2. Maybe it's just hard to read. And then the closing stock is $210,002. I look at that with my experience and I say, wow, that stock's gone up a fair bit, that closing stock. And it's this suspiciously round number of $210,002. It's almost like they put the 2 on there to make it look not too round. And in fact, that is not the real number.
Yep.
So when these accounts were produced in 2005 and this business was put on the market, we discovered that closing stock was not right. And the accountant had done the wrong thing and put an artificially high stock number there to artificially inflate this gross profit, which we're going to look at, because he wanted to help his clients to sell the business for a higher price.
Wow.
Which is literally deceptive and not telling the truth. You know, the owners of the business had no idea. They just thought, accountants prepared my accounts for me. There they are. But that is the wrong number. Each of those other preceding numbers, the 134,998 and the 145,612, are the exact right numbers from the stock take. The $210,000 is wrong, and the real number is about $150,000, $160,000.
Big difference.
So it's $50,000 above, which inflates the bottom line profit by $50,000 straight up. So they've deceived the buyer and themselves by $50,000. They're going to pay tax on that extra profit. So that's probably not a good idea, possibly not a good idea. So that's the main thing that I wanted to get out of that one. But let's just run through it quickly so people are with us. So in the first year, they sold $1.188 million worth of things. They had an opening stock of $134,998. They purchased $591,000 worth of stuff. Their closing stock was $145. That gave a cost of goods of $581. So $581, take it away from $1.188 million, gave us a gross profit of $607.
Gotcha.
I'm going to do the percentage in a sec. So the second year, $1.4 million, opening stock $145,612, purchase of $763,000, closing stock $210,000, cost of goods $699,234, gross profit $707,000. So, by the way, we noticed that the purchase has gone from $591 to $673. So that's sort of complicit with that increase in sales.
Mm-hmm.
But now let's just do the GP and see what the GP looks like as a percentage. So here we go again. Put the calculator on. Are we good, Jane? So to calculate here, we're going to go 607,716 divided by 1,188,736, I think that says, equals 51.12% in the first year. And then the second year, we've got 707,535. Geez, if you're listening to this, it'd be a bit boring. Anyway, hang in there, guys. Divided by 1,406, 769 equals 50.29%.
Ooh, almost.
So the GP's gone down a little bit.
Yep.
That's by my quick calculation. If you are watching this carefully on YouTube, you think that's wrong, you can let us know. All right, so that's the trading statement taken care of. Let's have a look at the P&L where I said every expense has a story. Are we good so far, Pete?
I'm up for it.
Okay, let's go. So we're back to the manufacturing business. Oops, so we recall that what happens here is in the P&L, we carry forward gross profit from the trading statement becomes the top line here. So the 601,483 is the opening stock in the previous year, opening profit and the gross profit in the previous year, and 1,071,000. Then to that, we either add or subtract different things. So see in the left-hand year, we sold something and we made $314,490. That was the sale of a lot of plant and equipment.
Yep.
And you'll see down in the current year how we're leasing equipment rather than owning it. So they sold that off, put $314,000 in the bank. Yoo-hoo, beautiful, got money. We received interest of $2,335. If you look in the current year, we received interest of $24,522. That's because we've got the $300,000 sitting in the bank from the equipment that we sold. So you could ask questions about that. Anyway, if you were buying that business, you should say that the interest received and the gross profit on the sale of assets are not sustainable revenue that you are going to earn, and therefore you would not include that as profit or revenue in the assessment of this business. So let's quickly run through the costs here and see if we can give everyone a bit of a guide as to the sort of stuff you should be looking for when you look at a P&L, and just to figure out, like detectives, what's right, what's wrong, and how you would run the business and how it would affect you. So let's run through. Here we go. Accountancy. So they spent $8,973 in the first year. And in the second year, what was it?
More than double. 18,557.
10,000 more. So what's the story? Why did it go up? And in fact, is that extra $10,000 related to the business or not? In this case, what it was is these people lived at Runaway Bay on the Gold Coast. They had a boat, which is part of the story. I'll come to it. And they have a manufacturing business. And the $10,000 is planning for their exit and retirement. I guess it was financial planning advice. And it probably doesn't relate to the admin of the business. So you could argue that there's $10,000 in there that didn't relate to the business. Advertising and promotion, very low. Bank charges, quite low. We've got to remember this is quite a long time ago now. Borrowing expenses, quite low. Cleaning is very low. Computer services, pretty low. Depreciation in the first year was $7,791. In the second year, is it $6,031? Yep. Electricity, very low. God, electricity's gone up a lot since then. Fuel and lubricants, insurance, pretty consistent. So we want to look at all these things. Now, seeing how we've got leasing charges in the second year, that's because instead of owning that asset, which we sold, we're now leasing equipment. And we write that, the cost of the leasing, which is an expense, reduces your tax liability. So that can be a good thing. Legal costs, $641. Licenses, registration, permits, motor truck expenses, newspaper and journal, nothing outstanding here. Postage, printing and stationery, protective clothing, productivity superannuation. So I want to point out there's two types of superannuation here. Oh no, there's not in this one, it's in the next one. So what that means is that's the super that goes to the staff. And that should be around about, depending on what year it is, 9.75, 10% of the wages. And it's a good idea just to check that. So the rent here, $19,225 and $19,200 is wrong. So we need to address this. If these people changed ownership, they own the property, they own the factory unit, and the rent would be something like $40,000.
Oh, wow.
So if you would buy that business, that would reduce your profit by that amount, 20 grand. Need to factor that in. So that's a very important thing to kind of look at, that rent. So see here, repairs and maintenance, $45,000 and $65,000. Do you know where most of that money went?
On that boat.
The boat. Yes. Yes. So
Shuffle it through the business.
yeah, exactly. Now, how do they prove that? And is that legit?
Yeah.
This is something, as a buyer, this is part of due diligence. You want to check it and see if that's true. But it is a lot of repairs and maintenance. So staff amenities, not much. Superannuation. Oh, there we are. There is two types of super. So that's the owner's super. Gotcha. And then telephone, travelling expenses, $6 grand. Wages, $384 and $435. 120,000 of those wages was owners' wages, not drawings, wages. And then workers' comp, which back in the day was low. So we haven't got the profit here for a reason. But what I wanted to just do was just sort of talk about expenses and what we can find out. So what did we find out here? We found out that the profit on the sale of those assets isn't really profit ongoing for the business. The interest should not be included. The depreciation may or may not be a real expense. The rent, when you're looking at these figures, is not a real number. We need to look at the real number, and that repairs and maintenance. So there's a lot of things in here that we can identify and use. Let's just go to the second business because I know we're limited on time. And there's some interesting little things to find here as well. So accounting, $2,000. So we're back to the retail business, which by the way was a jewelry business. And these people you'll see in a minute used to go overseas and buy their jewelry and bring it back to Australia. So 2,000 ish in expenses. See how the advertising went from 25,000 to 47,000?
Yep.
So what happened was they're thinking about selling the business. Remember I said the accountant inflated the closing stock number, and they spend an extra 20 grand a year on marketing and advertising to try and inflate, get their sales up. Yeah. So bank fees and charges, merchant fees is sort of in line with the sales. You need to check that. Cleaning, rubbish, clearing, depreciation. So see, it's gone from 5,000 to 16,000. That's because prior to selling, so prior to the current financial year, in the previous financial year, they spent a bit of money on rejigging the shop, new shop fit to make it look good. And they got a new lease, which you'll see in a minute. So you can find all this out in the financials, right? So what the question is, why is the depreciation more? What are we depreciating? It's the shop fit. Why did you refit it? Because we're selling it, or that the landlord required it to get a new lease. So we're finding out a lot about the business just from these numbers. Every number has a story. So fees and charges, freight and cartage seems reasonable. Insurance seems reasonable. Employee liability insurance is possibly personal. The interest paid's gone from, is it 8,000 to 9,000? I think it is. It's very hard to read that.
9,000.
Yep. And then there's higher purchase leasing costs as well.
Yep.
So the buyer has to ask themselves, am I taking over this high purchase liability or not?
Yep.
If not, then that cost doesn't relate to me. If so, then I keep that as an expense. So light and power, got to just figure out if that's reasonable. So in this motor vehicle expenses, there's quite a big chunk of depreciation, huge. So the buyer's not going to buy those vehicles with this business, this jewelry business. So that depreciation is not going to be
To take that
appreciated. That's right. So it's not a real cost. Petty cash, wow, that's a scary number, $22,000 and $26,000 a year in petty cash. Where's that going? What's it about? So if I was buying this business, or even if I owned this business, I'd want to know why so much money, $500 a week, is going out in petty cash. Is that right? Or, oh, no, sorry, it's 4,000. Sorry, it's still a lot. The 26 is the motor vehicle expenses. Sorry, guys.
It's still a lot.
Yeah. So then the rent is sort of in line with a shopping centre rent. Am I right there?
Yep.
Printing and stationery is quite high because we've got catalogues. So these guys used to do a catalogue in their local area. Replacements is very small. So superannuation. Here we've got two types of super. So we've got $11,000 in the previous year, $13,000 in the current year. But if you look at the superannuation in associates, so in this case, the terminology of the accountant preparing these accounts, the associates is the owners or the shareholders.
Yeah.
So see here that in first year they paid themselves $2,003 in super, but see what it was in the second year?
That's huge.
Yeah.
130,000 more.
So why would they do that? They did that because they were getting out, they were retiring. And
Dropping money out.
Yeah, they can create a fairly significant tax benefit by putting that money into super. That's what they did. Subscriptions is about $600 or $800. Telephone is quite high, $10,000 to $12,000, quite high for back in those days, 2005. So look at this travel costs. We spent $40,000 in the 2004 and $29,000 in 2005. That's going overseas to buy the jewelry. So is that an add back? Is that a real cost of business? It probably is. You've got to spend a lot of money to go overseas. Then we've got wages and another costs. So see how by looking at those P&Ls, we found out a lot about this business. And I guess the point of running through that today, we've sort of finished with that now, was just to enable people to figure out how important it is to look at a set of accounts, how valuable it can be to look at the trading statement and the profit and loss, and how you can, whether you're selling a business, buying a business, or you're managing your business, how you really need to know what those numbers are saying.
Yep.
We should not accept what the accountant's telling us when it comes to the closing stock, or some of the other numbers like depreciation. In transport companies, depreciation is a real cost. In other businesses, it's just a tax thing. So as a buyer, an owner or a seller of a business, it's really important that we understand what these numbers are saying. Would you agree?
Absolutely. And it's very, very powerful when you can overlay this with the other financial documents that you talked about earlier, where if you can align this with your budget, your cash flow forecast, your balance sheet, and you look at everything every month as a full story, all of a sudden you're not in a reactionary phase, but potentially you can be predicting the future, especially if you overlay cash flow forecast. You can go, okay, well, if I've got to put on an extra 2 people for argument's sake, what is this going to mean? How much extra revenue do I need?
Yeah.
If you're thinking of selling your business, and in this case, with the retail where they've taken out $130,000 super, all of a sudden their net profit has gone from prior year from 120,000 down to 36. Just on the surface of it, if you don't understand the numbers of that prospective buyer, they can go, oh, something's happening in the business.
You would
There's
think
something
so.
wrong with
That's
the business.
right. Exactly.
Yep.
But you need to explain those numbers.
That's right.
Why is the marketing money spend gone from 25 to 47,000?
Yep.
Why was that super paid? And therefore, what is the real profit in that business?
Correct. And also don't forget that if in that case, like with the marketing, you've upped it, you could potentially sour the opportunity in someone else's mind, because they might look at it and go, well, hang on a second, I can see that you've just inflated it. So is it really not that successful?
Yes.
Am I going to experience a downturn?
Yeah.
Those sort of questions.
And this is why, by the way, for sellers, they need to get, you need to take a set of accounts like this and get your accountant to provide what we call add backs or adjustments. Or in America, in the US, they call it recasting. So you have your set of accounts. So that's it there shows the current year's profit is what, 30,000 or something?
36,300 or 500.
So to that, you would add a list of adjustments or add backs, which is that personal superannuation, depreciation. They spent some money on legal advice in there to get the new lease done. And any one-off thing, and also take out any interest earned or asset revenue from sale of assets to get a real profit number. That's what the buyer's going to do their due diligence on. You're going to make it much easier for a buyer to buy if you've done those add backs and adjustments before you put it on the market.
Okay.
If you give a buyer those sets of accounts, they're not going to be interested.
Okay.
But if you get your accountant to do the add backs and adjustments ready for due diligence, the buyer can then look at that business and compare it with other businesses they're looking at and make a judgment, and they know that's what we're going to do the due diligence on.
So in fact, what we're talking about is sale ready preparation. So don't rush to the process of, listing the business, but rather think ahead, think a year ahead and go, okay, in a year's time, I'm thinking of selling my business. What are some of the things I need to do today to get it ready? That includes get the accountant involved.
Yeah, exactly. So the accountant is like the captain of the ship. He's steering the ship. But if you don't know where you're going and you're not checking that we're going where we want to be, then you're just a passenger and you've got no control, and that's not good. It's your business. You need to take control. You need to tell that captain of the ship where he wants to be, where you want him to be. You need to check that he's on course. So don't just accept what the accountant gives you, and make sure that you get the accounts prepared in a way which, first of all, you must understand every number. If you don't, you need to ask questions and get to the point where you do. And if you feel like that's all too hard, that's not the right way to do it. Get somebody in to help you with it. Would you agree?
Absolutely. Fantastic advice.
By the way, how many business owners do you see that don't understand the numbers in their business?
Probably say 90%. Vast majority, no idea.
That is not good.
And we've had, we've got a couple of engagements now where one, probably about 4 or 5 months ago, we sat down and we had a look at the P&Ls and we had a look at other figures. And we were able to raise some significant issues in their business to the business owners that they weren't even aware of. They're like, oh, I didn't realize the accountant did that. The accountant just added some figures in and did some certain things in there. I'm like, what's this doing in the P&L? They're like, oh, no, that's not it, but look at it. It's in there. They're like, oh, we didn't see that.
So, so we'll finish on this. Just one more point. It's a very common thing for a business owner who doesn't understand their numbers, and I don't know what percentage of business owners that is, but if they're taking drawings, quite often, and especially in the smaller businesses, a business owner taking drawings thinks that drawings is part of the profit. So they'll say, oh, I've got $32,000 profit there, but I'm taking $100,000 out in drawings. So my real profit is 100 plus 30. No, it's not. When you take drawings out, you're just drawing down on the cash reserves that you have in the bank. That's out of the balance sheet. That's nothing to do with the profit and loss. That profit is the profit. So if you're taking drawings, all you're doing is taking money out of your bank account.
Producing it.
That is not part of your profit. So don't think of it that way. And if you want to know more about that, talk to me or talk to your accountant.
Yep.
Give us a call. So something different today. Hope it wasn't too boring. Hope you can handle listening to that without seeing the numbers. If you want to have a look at the numbers, it's on the YouTube channel.
I think we look next time around. We're going to go through the others as well. It's such a powerful activity, and yeah, it might seem a little bit boring to some, but trust me when I say it from experience. When you've got a business and you know your numbers, you're in control.
Yep.
You don't know your numbers, you're not in control.
Exactly.
Simple as that.
Exactly.